Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. August 20th, getting late in the summer. For a late summer week, a lot of things to cover today. We'll keep it tight. We'll try to focus on the broad points. Number one, indexes, kind of a quiet week. Nothing down more than 1%, with the exception of small caps. Small caps have been really a canary in the coal mine here that we hope doesn't drag down the rest of the market. Remember back last, let's call it October, but you started to see it in September when we look at this chart. We started to notice the outperformance of small and mid equity versus the S&P. Really went on a tremendous rip here. You get into March, you have 20% outperformance in the Russell 2000 versus the S&P 500. That's performance you really need to partake in. But look what's happened since then. All the way down through this week to just a 5% outperformance over this stretch. That's a real drawdown in small cap strength. Now, we'd like to see it dig in here somewhere. Right in this area, if small and mid could dig back in, we'd feel confident in the next 30, 60, 90 days in the market. But we really need that breath to kick back in. It's concerning. We're positioned in our U.S. portfolio somewhat defensively. And if you look this week, what were our top sector and industry performers this week? Real estate, that's the REIT business. XLU, the utility business. Let's go over to Staples, Costco, Walmart, Procter & Gamble. That's where your strength was. Real weakness in anything economically sensitive. Energy, down 7%. Natural gas hung in there, but oil really pummeled this week. So weakness in basic materials. You saw weakness in industrials. From a risk-taking standpoint, you saw tremendous weakness in emerging markets. So we need to keep an eye on the appetite for risk. As I said, we're somewhat defensive, and Todd Engelhardt covered last week the fact that we rotated in our U.S. portfolio into those three more defensive sectors, being staples, real estate, and utilities, out of higher beta or more aggressive sectors. So we hold some cash in U.S. ETF. We hold some cash, about 10% in tactical trend. International, which really, developed markets has traded well until this week, but really needs to see a bid to keep us from raising more cash here. You know, one thing we've focused on is the fact that the last 10 years have seen the U.S. markets dominate the international markets from a relative strength standpoint. And that continues. We saw a brief bounce in international versus U.S. late last year and early this year. We had some hope that that could continue. And the reason we'd like to see that continue is not because we want to see weakness in the U.S., just like to see more breadth in worldwide equity indexes. It's a healthier market. Right now in the U.S., tight breadth contained to the NASDAQ 100 and the top S&P names. Need to see an expansion there. In terms of interest rates, John Mousseau will be covering that. Kind of a quiet week. In terms of the economy, when we look at commodities this week, with the real plunge, not just in oil, but in some of the metals, have to be at least on the lookout that our economic numbers may have peaked. Listen, peaked at a very high level. And maybe we're in for just a dampening back down to that 2.5%, 3.5% growth area. Be interesting to follow. Everyone have a great weekend. We'll see you next week.
Good afternoon, everybody. It's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon, early on August 20th, another summer doldrum week. Yields down this week. 10-year bond yield down to, basically 125. down a few ticks. 30-year bond yield down to 187, down 6 ticks. Take your pick, right? You have a plethora of bad news this week. The continuing saga over in Afghanistan as we remove troops, with the Taliban taking over. Not good. You have the terrible tragedy in Haiti with the earthquake followed by a tropical storm there. Not good. You have the terrible COVID story, Delta, in the southeast states, 90% plus, with non-vaccinated patients. They're very tough situation. All of this is just kind of bad news and settling down on the market. Muni yields really unchanged during the week. So basically the 10-year and 30-year are at 70 and 80% ratios respectively. A touch cheaper. This week, you see our chart on the initial jobless claims, which were right on the nose at 350,000 this week. What's interesting is that you are basically back to pre-COVID levels. So when you hear something this week where the Fed is actually talking about tapering, which is a movement off of the talking about tapering, it has some credence to it because you're back to those levels. Not that they might not push it out a few months and watch more, but you clearly have economic indicators that are another sign that you're back to pre-COVID levels. That's a very important part of the equation, because as we get into the fall, the bond market is going to have to balance on a three-legged stool of a Fed starting to looking at tapering either later this year or early next year. You're starting to look at an infrastructure program, which will have to be financed, so that's more issuance. And it'll have the part three of that stool is, of course, the inflation numbers, which have remained high on a month-over-month basis. And as we've said here before, we are watching that to see how it plays out and how that run rate of the trailing 12 months inflation plays out. Does it go back to pre-COVID levels around the 2% level? Or does it stay elevated at the 3 to 3.5% level? That clearly has impacts for bonds as you go down the road. We think the answer is somewhere in the middle, and that the run rate of inflation will clearly be higher than we were used to pre-COVID. On the muni front, I think you'll start to see some issuers come to market. Now that they know the Fed has tapering in their periscope, I think you'll see issuers start to pick it up a little bit and get to market before tapering. So that could actually make for a little more attractive municipal bond yields as you move further into the year. We'll be back with you next week, and we hope you have a great weekend, and please stay safe. Thanks.